Hi everyone, this is Rob Roy and welcome to the Elliott Elite U.S. Market Update. Before we go too deep into the U.S. charts, and here is the current chart of the SPX on the U.S. market, I wanted to make a comment real quickly if I could. A couple things really. In going through and looking at the education that Hub provides, it is filled with, this organization is filled with people that have the utmost integrity, that truly care about making a difference in the world and making a difference in your own individual financial futures, current situations and future as well. That's just rare. I've been in the financial world. I've been trading for 21 years. I've been in the financial world for longer than that, and there's so many people with ulterior motives that say what they need to say to benefit their own pockets, and just to find a quality organization is unusual. It truly is. And I really enjoy reading Tom Scollin's commentary on the Aussie market and how the Australian market affects the world and vice versa. And I wanted to make a comment on his one of his recent pieces on the fact that the U.S. and Aussie market aren't necessarily in sync, but do they need to be? I don't know if that was a question posed to him, etc. But I couldn't agree more. A lot of people think that our markets move directly in sync, but how could they? We have different economies, we have different tax structures, we have different monetary policies, and yes, they move in a similar fashion quite often, but not necessarily in sync or in exact fashion. And when you think about that, economies of around the world all have different individual situations as well. So, in general, there's similarities, and when we take a look at the charts, you'll see that there's a similar chart structure. But I thought his commentary was excellent, and please don't discount the quality of the education and information you're getting from the Hub Financial Group. In my opinion, it's second to none. So a little chuckle there because part of it, so it feels like maybe that's beating my own drum, so to speak. But I feel blessed to be a part of it, not necessarily adding to it. I just hope that I can provide some insight to what's going on in the U.S. markets. And fortunately, in recent weeks and months, we've been pretty darn accurate on what's been going on. So here's the U.S. market. Here's the ASX 200 there in Australia. And you can see, there's some similarities in the fact that we have a consolidation in a nice symmetrical triangle. I'm going to go through that in the U.S. because I don't want to spend too much time commenting on your market. That's not my responsibility. But you can see that the charts are similar. But look how long the Aussie market went sideways before you had a bit of a break, and then your consolidation. And when you go back to the U.S. market, we had a much more pronounced upward move before that last more vertical move and this consolidation. So similar, yes, in sync. I don't necessarily think that they are, nor necessarily should they be, because policies are different. That would make you feel more like markets are manipulated, wouldn't it? If they were directly in sync with so many differences in the economies of our two countries, the size, etc. Anyway, so back to the U.S. Here we are with the S&P 500, and we have this really nice symmetrical triangle. They don't get much better than this. It's one of my favorite patterns that exist, which is a run up in the market followed by a symmetrical triangle. This is the highest percentage breakout pattern that you can see, in my opinion, in my experience, and it falls right into these triangles, which, as you know by now, you should know by now, is one of the corrective patterns within Elliott Wave, and we are going to break one way or the other. The pattern does not tell you which way we're going to break, it just tells you we're going to break, but based on the rules that we utilize, we can come up with approximate points. And the way we do that is we measure the mouth of the triangle, the widest part. And without getting too detailed in this, because we'll get into it in the future and further education, webinars, etc., is you measure the mouth of the wedge. Highest percentage is that you're going to move 80% of that. Okay, so that can give us some rough targets on what to expect. So if we get a downward break in the markets, we could look for a move potentially all the way down as low as 25.10, which would be basically a test of the lows, but with a slight break below that. And what I mean by a test of the lows is, I commentated on this before, that there are 3 different ways to test a low. You can stop just short, you can come all the way down and hit it exactly, or you can break it and scare the heck out of everybody, which really flushes the system and sets things up very ripely for a continued move higher. So then we look to the upside, and applying the same rules, if the market were to break to the upside, the upward target, and this, it's not giving you a time frame here, I'm just giving you targets, would be up here around 29.90. So those are potential targets for where we could move from this point. And again, I'm not trying to say what time frame this is going to happen, etc., nor am I trying to pick which direction we're going to move. We did think that we were going to get this breakdown, we were going to get this correction based on all things that were lined up. We had that. Now we're in a consolidation mode, and we're set to move one direction or the other from here. Looking at the SPY and bringing volume into the mix, you can see that we are still hovering in that just a bit above average volume. We had a little bit of quiet volume in this area here in the beginning of March, and then we had a little bit of a move higher and then a comeback to the breakout point, and a little bit above average. That's slightly unusual, but you know, the extreme rally was a bit unusual as well. So we'll see where things go from here, but next week certainly promises to be quite interesting as far as what direction we break out in the markets. Looking at the VIX, here we are again. We've talked about this. Go back and watch the other recordings if you haven't, because I don't want to say the same thing week after week here, because that's not good for you or for anybody. But we talked about how 15 had been resistance for so long and it was going to act as support now. Here we are. If you look at this, you could say, hey, you know, the more likelihood is that we bounce from here if that's going to hold as support, and if we do, that might tip your hat towards a downside breakout in the markets. But if we break this level, then we're probably going to go back all the way down to these lows. I would find that a bit surprising if that were to occur, but I've been surprised by the markets before, and if you ever get to the point where you think you know exactly what's going to happen in the markets and you don't protect yourself from being wrong, you're not going to be a trader for very long. There's absolutely no doubt about that. Just to update you on some of the other charts. Oh, by the way, while we got the VIX, let's do the Bulls and Bears Investors Intelligence Survey that we talk about from a sentiment standpoint as well. The Bulls are right around 55 at this point. The Bears are at 15. So those are at the levels where we would start to consider that, hey, we still have a very high level of bullishness. Now, we're nowhere near the extreme levels when we got up to 65 on the Bulls, and we've come off that low of 14 on the Bears, but just barely, so not a whole lot. So my point here is we're still bullish enough that there is ammunition or momentum available in the market for a downside breakout out of this triangle, if that were to indeed occur. On the dollar and the U.S. dollar, still haven't figured out what it wants to do, but we have a Fed meeting coming up this week. It's a 2-day Fed meeting. The announcement will be on Wednesday. We'll see how that comes out and see if the Federal Reserve does anything to surprise the markets. The expectation is for a 25 basis point rate hike. Anything other than that would be a surprise. In other words, if the Federal Reserve did nothing, that would be a surprise. If they raised 50 basis points, that would be a surprise. But a 25 basis point rate hike is factored in. Still, no break to the upside in the dollar, which is what you would think would happen with the onset of increased interest rates to support a currency. Well, the interest rates aren't going up to support a currency. They're going up to offset potential inflation from the easy money that we've had so long. But in the end, a side effect of rising interest rates is it supports the currency a bit. But so far, no indication of that. So let me take that arrow off. I don't want to be misleading that that's what you would expect, but it hasn't happened yet. We're still floundering around, and you know this is down at a extended Fibonacci level. We've gone through that. Again, I don't want to do the same thing every week. Go back and watch the previous recordings if you're not familiar with it. TNX, this is the interest rates on the 10-year note, still hovering in this area here. And again, that is a fib extension level. I can't impress enough, and I will talk about this a lot week after week, of how amazing Elliott wave and the Fibonacci ratios are. And Elliott wave was really hot for a while, and then it doesn't seem to be quite as prevalent as it was. That's a mistake. If you used it in the past and you haven't been using it lately, why not get back into it? Get back into utilizing Elliott wave, because it is the premier indicator out there, and you're in the right place because you've got the software program with Profit Source or Integrated Investor that takes the greatest advantage of not just the traditional Elliott wave, but these corrective patterns that will be the center of my focus, have been and will be for the months, weeks, months, and hopefully years ahead. So still nothing changing there. But I also wanted to show you this. We introduced this chart as well, just again as another explanation of the zigzag pattern to the upside, highlighted all the Fibonacci levels. Again, all this is extremely detailed in past recordings, and here we are still finding resistance at that extended fib level, and it is just amazing how Fibonacci ratios act as support and resistance levels, and in such a strong manner. So there's not a whole lot else to say in this week's report, because the market is just poised to break out. We'll have a lot more to talk about next week, so be sure to tune in to next week's recording. Hope we've had a wonderful week. Take care, everybody. Look forward to talking to you again soon.